Hello everyone. In this session, I'm going to discuss these topics that are on your screen. Types of markets, circular flow of income or circular flow model, leakages and injections, gross domestic product, that is GDP. So these are different measures of national income accounting. GDP, gross domestic product. I'll define GDP in a moment. GDI, gross domestic income. NDP, net domestic product, NDI, net domestic income, NNP, net national product, NNI, net national income, PI, personal income, DI, disposable income, and GDP per capita. We measure GDP using two approaches. One is called expenditure approach, the other one is income approach. I will also discuss the difference between nominal and real GDP and define economic growth and its sources. Finally, I'll discuss problems in measuring or calculating GDP. So these are different types of markets. So product market is a place where buyer and sellers interact. It may be physical, it may be virtual, to buy goods and services. This is what we call product market, where sellers and buyers are selling and buying products, different types of products. Then we have factor market. By factor market, I mean we are buying and selling factors of production or resources, for example, labor market. Then we have stock market, bond market, foreign exchange market, or foreign currency market. So forex market, bond market, stock markets, where you are buying and selling stocks or bonds or foreign currencies. These three markets. These three markets are called financial market. So financial market includes stock market. That is the selling and buying of financial securities. So we'll discuss these markets in a moment. So now let's start with this circular flow of income or circular flow diagram. And let's discuss this model in detail. So in circular flow, or the circular flow diagram represents the flow of goods and services and money between producers and consumers through various markets. So these are most important component of this model. Number one, producers, that is firms or businesses who are producing goods and services, and consumers who are buying these goods and services. Why? The model consists of four sectors: business, household. By household, I mean consumers as well, government, and foreign sector. So these are the four sectors. And then we have three markets: product market, factor market, and financial market. Okay. Let's start this diagram. So I'll develop this diagram by starting with only two sectors, and then we add. Okay. So this is considered a simplified economy with only two sectors, that is businesses and households. And these arrows are very important, right? That is why we call it circular flow. So it must move in a circular fashion. If you look at this diagram, see, we assume that households provide factors of production to businesses. So I'm assuming labor, capital, enterprise, and natural resources are owned by these households. This is the assumption, basically. But we are just making this model simple by assuming that suppose households are providing labor services to these businesses. You know, when households sell their services to these businesses, of course, in return, household will get what? Will get wages, if they are providing their labor services, if they have capital, then they will earn capital. If they are providing, natural resources, then they will earn rent, etc., etc. So the movement is this. See this. So households, and I'll delete this. So household are giving factors of production in this direction. So it's moving from household sector and going towards businesses, but not for free. Of course, they are charging for their services. And why businesses are actually buying these factors of production? In order to produce goods and services. So these businesses are then giving these goods and services to household, not for free. Of course, they are selling these goods and services to these households. So you can see the circular flow, right? So the goods and services and money are moving between these two sectors. Let me erase this. Now see this. So now I just add one more uh, link. And this time, notice this is what I said, that if you are providing labor services, then you are earning wages. For enterprise, you are earning profit. For capital, you are getting interest. And for natural resources, you are earning rent. Now see, look at the direction. The direction is, see, this direction. That is, this money is coming from businesses and going towards household sector. This is in dollar terms, right? That is why it is written here. It's dollar, money. So money is moving in this direction. Labor services, capital, enterprise, and natural resources are moving in this. Similarly, just look at the upper side. The goods and services are moving in this direction, but these households are paying money in terms of basically prices of these goods and services. So they are spending money. So this is what we call it. Consumption is spending. So they are spending money. And this money is going from household sector to business sector. So look at this. There is a circular flow. So I am paying money to buy goods and services, and businesses or firms are paying money to buy our services in terms of factors of production. So there's a circular flow. Now add more sectors and add more markets into this simple model. So although it is written here as well, so you can see that households pay for goods and services, that is called consumption spending, and businesses pay for factors of production. Okay. Now you know by definition where these households are now going to buy from these firms directly from their manufacturing unit. Similarly, these businesses are now going to buy directly from these from households. There's a market involved, and this market is called product market. Why I'm saying that this is product market? Because you can see buyers are buying these goods and services. Sellers, that is these businesses, are selling their goods and services. So this is the market for product. So that is called product market. Here, households are selling factors of production, businesses are buying factors of production. So basically, we are selling and buying factors of production, resources, inputs. This is called factor market. So I have now introduced two markets as well, product market, factor market. So you know product market and factor market. So I remove that from the diagram, and let's see this. National income, that is the total income, is the sum of all spending or sum of all incomes earned. So if I want to find out what is the value of these goods and services in this economy, which is very simplified economy, I can calculate in two ways. First, I can calculate using only this, using this. This is the value of all goods and services that these household sector bought from these businesses. So dollar consumption is spending in terms of dollar is the total value of goods and services that are being produced by these businesses. So that is one way to calculate income of this country. The other way, and this is called expenditure approach. Why? Because I'm adding expenditure. Consumption is spending. These households are spending money on these goods and services. That's one way. The other way is that why not we just calculate incomes? So I know that this is spending is coming from selling these factors of production. So the income is going from businesses to household. So if I calculate all these rent, wages, interest, and profit together, I should get the same answer as my expenditure because this is the money that these households are receiving and they're spending. So either you calculate the income of the whole country, you can't add goods and services. You can't add one computer and one chair, but you can add the value of those two goods and services given the price level. So either I can calculate the total income of the country, I mean total value of all goods and services produced by calculating all expenditures, adding all expenditures, or we can add all incomes that those factors of production are earning. Of course, with some adjustments, because the economy is not that simple. So we will discuss those adjustments as well. But here I'm just discussing this model and give you an idea how to calculate the total income of the country. So let me erase this, clear these annotations, and let's move to the next. Now there's a problem because these households, when they sell their factors of production to the businesses, households are not going to spend all their income on buying these goods and services. Households also save money. Now there are two options. Either you just keep your saving under your pillow or you save with a bank. So this is what we call financial intermediaries. This is not financial market. This is financial intermediaries. By financial intermediaries, I mean uh, that so these institutions, for example, banks, they take money from you and lend money. So they basically actually borrow money from you and lend to investors. Okay, so this is what financial intermediaries doing. They are basically the middleman, basically. So they're taking savings and then giving as loans to the businesses. So when households save, they will save with these institutions, that is suppose banks, and then bank give loans to these businesses. So this is what we call investment. Okay, so businesses are borrowing money from the bank for investment purposes, right? They're spending money by borrowing from the bank, and bank is making money. Why? Because bank gives suppose 2% to household on the saving, but loan this money at 4%. So this is the interest rate spread. So they are making 2% interest. Okay, let me clear this. So now I added savings and investment. Then there's another factor. These households are, yes, spending money buying goods and services. Households at the same time are saving money with the banks. Households are also spending money buying imported goods as well, not domestically produced goods that these business sector, uh, these domestic producers are producing. They also buy from uh, outside Canada. That is imported products. So this is, remember, it's dollar. So dollar payment for imports. So the dollars are actually leaking from the system. The system is basically this: from household to business, business to house. This is the main system. This saving is also a leakage from the system. But you see that we have a leakage here, but with the help of financial intermediaries, we are injecting this money again into the system. So that's fine. Similarly, this money, this dollar imported payments for import is a leakage. This money goes to the foreign country. So it's out of our system. But these businesses, they are not only selling their product to these households, they're also selling their product to the other nations. For example, United States. So these businesses are also producers are also exporting their products, and they are earning exports revenues, right? So this is dollar payment for exports, and this is coming from foreign sector, foreign country to the business. So this money is coming into the system. So exports is injection, is the money is injecting into our system. Imports are leakages because this money is going out of our domestic um, economy. Okay, now it would be more complicated because when you buy foreign goods in the foreign market, you are using your Canadian dollar, and if you're buying from US, then you need US dollar. So you have to convert your currency from uh, Canadian dollar to US dollar. Similarly, when you are exporting something, then these buyers in the foreign country will need Canadian dollar in order to purchase our product, right? By giving US dollars. So there's a market for foreign exchange market as well as operating, which I have not shown in the diagram. It's not shown in the textbook as well. Okay. Now let's add another sector, government. So government is in the middle, and look at the role of the government. Government, is not working basically, right? Or is not a business, right? It's not considered as a farmer producer. So government is actually, we do have crown corporations, so we do have businesses, right, owned by the government. So now see this. What government is doing? Government is imposing taxes. So sales tax and other types of tax from the households. So households are buying money from these businesses. Households are buying goods and services, buying money, not buying goods and services from business. Households are also buying goods and services from foreign sector. Households are saving, and households are also paying taxes as well on in their income. So is this is the direction. Look at the direction. It is from household to government, like this. Similarly, corporate or these corporations, they are also paying taxes to the government. So this money is going to government. Why government is imposing taxes? In order to use these taxes, where one, government is also spending money. So government, for example, if government uh, is spending money buying hospital beds for Calgary Hospital, then government will buy from these businesses. So this is government expenditure. Now dollar is going back to these businesses. And similarly, government is also imposing income taxes, but also giving money to these households. This is what we call transfer payments, such as scholarships. So if you're receiving scholarships, basically you're not paying taxes, but you're receiving money from the in the form of scholarships or aid. So see, taxes are leakages. Why? Because they are out of the system. The system is household and businesses sector only. And transfer payment and government expenditures are injections because these two money are actually going back um, into this system. Okay. So now I've given here, these are leakages, savings, taxes, and imports. Now, in order to just make, this is just a, I don't know, but, this is just to make it more look simple. I could have written like this: government spending plus transfer payment. These are basically injections. But we take this transfer payment, here you have plus sign, so here we subtract. So we just subtract and say, okay, taxes minus transfer payment is leakage. And government spending is injection. Taxes minus transfer payment is leakage. And government spending is injection. Imports, leakage, because this money is going out of the system. Exports, money is coming into the system. So these are leakages and injections. Now the economy, the whole country is in equilibrium, which we will discuss in later chapters. Then your leakages must equal to your injections, not individually, but together. That is savings, taxes minus transfer payments plus imports. If you add all of them, and if injections, investment, government spending, and exports all together, if they both are same, we say that the economy is in equilibrium. Okay, we will discuss this later, but I'm going to now discuss what would happen if leakages are not equal to injections. So suppose if leakages are greater than injections, or if leakages are less than injections, what would happen? Look at this. This next slide. So I've already discussed this, which we will discuss later as well. So at equilibrium level of income, total leakages must equal to total imports, or injections. These are notations that we are going to use. S stands for savings, IM is imports, T taxes, I investment, X exports, G government expenditures. Notice here, I just deleted this transfer payment. So just for simplicity, I'm assuming that transfer payment equals 0. Okay. Now, economic growth and recession. What is economic growth? Economic growth when GDP is increasing, that is total income of the country. Recession when GDP is decreasing, that is total income of the country is decreasing. Now, look at these two cases. If injections are greater than leakages, it means money, dollars is coming into the system more than money going out of the system. If this is the case, that is, if you have investment, government expenditure, and exports, they are more than savings, taxes, and imports. This is called economic growth, because growth will take place. You have more money into the system, and therefore you will be producing more goods and services. If leakages are greater than injections, the economy contracts. That is, money is going out of the system. So leakages, these are leakages, are more than injections. And therefore we have a recession. And that is why the one solution of the recession is to increase government expenditures. So government should increase its expenditure, or we should encourage more investment, or we should give subsidies to our export sector. Why we are increasing these three factors? In order to have more money into the system, so that will be used to produce goods and services. Okay, that is basically to increase the demand for goods and services. Okay. Now, so that's all as far as circular flow diagram is concerned. Now we start a new topic, that is gross domestic product. The definition is written, that is taken from your textbook. The value, that is total value, of all final goods and services. By final goods, I mean those goods that are ready for consumption, not intermediary goods or intermediate goods, produced in a period. So time is also important. You cannot say that GDP is 1.6 trillion. Uh, that is incomplete information. You must say that GDP is 1.6 million in 2020 or in the first quarter of 2021 or in 2 quarters. The time period is important. Normally a year within a country. So within a country means whatever being produced within the boundaries of Canada will be included in GDP. That is why we call it domestic product. Gross means total. Domestic means within the boundaries of a country. Now I have copied this text from this article that I've already attached. What do the different measures of GDP tell us? And this is written by Philip Cross, working paper published by C.D. Howe Institute. So there are three basic ways of measuring GDP. There are three ways, but we will discuss only two. These are the sum of all expenditures. So either we add all expenditures or we add all incomes or we just use the value added uh, of all industries. So let's read this further. Expenditure is the best known since it is based on the famous equation Hicks introduced in 1940 that is still taught in basic economics courses, right? So in our textbook, GDP equals the sum of personal consumption, that is one type of expenditures, which I showed you in our circular flow model, which was a very basic model. Investment expenditures, you see that investment expenditure as well, because it is actually from savings. Government expenditures, when government spend money buying goods and services from the businesses, and exports minus imports as well, because imports is actually a leakage, exports is an injection. Now, why we are subtracting import? We don't have to. Basically, why not we just add personal consumption, expenditure, investment, government spending, and exports? These are four types of expenditures on our goods and services. By export, I mean foreigners are spending money on goods and services. We subtract imports because when we write personal consumption, this personal consumption expenditures, so we don't give you this data that, okay, every month I buy vegetables. Some of them are produced in Canada and some of them are outside Canada. It's very difficult. So what we do, we just add all consumption expenditures, whether it's imported or locally produced goods. And then at the end, we subtract all imports because we have data on imports. So we subtract all imports. I have the expenditures only on domestically produced goods. So that is why we are subtracting imports. So that is called expenditure approach. Under the income approach, incomes consist of all income earned by labor and capital, mostly labor income and profits, plus the mixture of the two earned by farmers, small businesses, and renters. Finally, so this is another method. I'll show you how to calculate GDP using income approach. Finally, industry GDP is the sum of value added by goods and services producing industries, broken down into 21 major industry groups such as manufacturing, construction, finance, retail trade, and so on. Value added, this is the definition of value added, is the gross output of an industry minus the inputs it purchased from other industries. So if we add all value added of all goods and services producing industries, I will get the value of GDP. So these are three different methods: expenditure approach, income approach, and value added approach. But we will discuss only expenditure and income approach. So let's talk about first expenditure approach. So this is expenditure approach. Statistics Canada's expenditure approach is basically they calculate in this fashion. Spending on consumer goods and services, that includes durable goods, non-durable goods, services, etc. Then investment, different types of investment. Spending on new capital goods, including machines, tools, construction, etc. Then government spending by all levels of government, and net exports. So rather than writing exports minus imports, we write net exports, and we represent net exports as NX. So NX is net export, that is exports after subtracting all imports. We just add all these four terms to get GDP. And the notations are this. For expenditures, we call it C, capital C, then capital IG, that is gross investment, and then this is government spending is capital G, and net exports is NX, which I've already written here. Right. Now remember, this gross investment includes inventory investment as well. For example, suppose I want to calculate GDP in 2022, for example, right? And Toyota, suppose in this year, in 2020, produced, let's say, 10 cars. So 10 cars being produced by Toyota in 2022. These 10 cars must be included in the GDP of Canada for 2020 in 2020 or in 2022, sorry. Okay, but the problem is that Toyota in this year 2022 were able to sell only 7 cars, not 10. So the value of these cars can easily be included because they have already been sold out, and therefore whatever be the price times 7, you get that expenditure. But what about 3 cars? No one has bought this car. So Toyota will actually add these 3 cars into their inventory, right? And the Toyota will sell these cars maybe in 2021. But these 3 cars will not be included in the GDP of 2020, oh sorry, in 2023. These 3 cars have already been included in 2022 GDP in the form of inventory investment. So inventory investment is a part of investment and without any depreciation. That's why we call G, small g. We just write in the subscript as G, that is in gross investment. Sometimes we simply write I, but it means G basically, that is gross investment. Now, what is Statistics Canada income approach? And you have to go to the stats. Let me check. Yeah, you have to go to Stat Canada website, statcan.gc.ca. Just go to this website and click GDP, and then you have data on income method and expenditure method. So income method, this is how we calculate income method. This is compensation of employees. So you add compensation of employees, I mean basically wages. Then you have gross operating surplus. This is the profit of businesses. Gross operating surplus means whatever they earn, and then they subtract all this cost, whatever is left, right? So this is their profit. That is also a form of income. Then we have gross mixed income. Gross mixed income means that if you're doing your own, you are just you are not an employee. So I'm not talking about a firm or corporation. So if you are working by your own, then you are earning money that will not consider as wage, right? So that will also be included in your GDP. Okay, so just give me a second. just opening another file. So just hold on. Yeah, okay. So just it's not given there. So basically, uh, gross mixed income is a concept for unincorporated enterprise. So that is not a corporation, right? This includes small family businesses like farms and retail shops, or self-employed as taxi drivers, suppose lawyers and health professions, right? So these are all included in gross mixed income. Once we add all these three income, then I will have to make adjustment. First adjustment is taxes, that is net of subsidies on production, not income taxes. Remember, this is taxes on production. What are taxes on production? Such as registration fees, uh, land revenues, and stamp duties, etc., etc. So you have to subtract because this is not the income. And then because in the price this is included, taxes on production is included in are included in the price. You have paid that price, but that is not, those sellers who are receiving this price, taxes are already included on the production, so you have to subtract. That is not their income. And also indirect taxes. By indirect taxes, I mean taxes on product, such as excise duty and sales tax, etc. So you are also paying sales tax in the price. So suppose if I receive $1,000, this is not my income because I have to pay taxes as well. $1,000 includes all these taxes. So I have to subtract these taxes. Once I subtract these taxes, then in the actual PowerPoint slide, all this information is given there. So you will get GDP using income approach. Now, why not I give you actual data? I don't remember. Okay, let's see this. So this is just an example. This is not, I guess, I think this is actual data, but you have to, see your textbook, right? For which year. But I have already told you to just visit Statistics Canada website, and where you can find the um, data on GDP. So look at this. Uh, First, on the left column, I have these four expenditures. So net export is negative. By negative, I mean we are importing more than export. That is why it's negative number. And when you add these all four numbers, so first add three numbers and then subtract the fourth one, you get GDP using expenditure approach because we have added all expenditures. Remember, it says at market prices. By market prices, I mean the price that prevail in the market. So you go retail pricing basically. So you go and buy these goods and services, paying the market prices. So 1,820 suppose $1 billion or $1.8 trillion. Then we have other measures, what we call national income accounting. So if I subtract depreciation, suppose depreciation is 307. Why I put a negative sign? Because I have to subtract this. That's why it says less. So if I subtract depreciation and if we subtract indirect taxes, net of subsidies means if you're receiving money from the government, you have to subtract first and then get that number. So, when you pay price of any product, these taxes are included in the price. So if we just subtract these indirect taxes, and also if you subtract depreciation, what we get? We get, instead of GDP, we call it NDP. N from G to N. G means gross, N means net. Net means I subtracted depreciation. That is why I call it net. This is the net income after depreciation, after excluding depreciation. And then I subtract taxes as well. So when you subtract taxes, it means you are not calculating the value of those goods and services at the market price, but at the basic price. Basic price means price before taxes, before you add 5% taxes, sales tax, for example. So that is why we call it NDP at basic prices. That is $1.405 trillion. Now, if you add plus minus net foreign factor income, I'll discuss this in a moment. That is suppose negative 33, and this could be positive or negative. Both are possibilities. I'll discuss in a moment. So when you adjust this, you get net national product. Why national product? When you make the adjustment of net foreign factor income, which I'll discuss in a moment, when you adjust this, then net domestic product is converted into net national product. Now we can get the same answer if we use income approach, of course, with slight adjustments. So these are the adjustments. First, I told you earlier as well. These are the three incomes. That is income of employees, all employees, then business income, and then self-employed income. And then you subtract, add. Oh, I said earlier subtract. No, you have to add taxes and indirect taxes. Let me come here. Let me go here. I'm sorry if I said. So basically you have to add, you have to add everything. So you don't have to subtract, right? This is should be added. Why you are adding? I know that I said earlier, that is correct. This is not a part of your income. You are not receiving, government is receiving this money. But in expenditure approach, we have added these taxes because we calculated market price GDP, market prices. Market price includes taxes. So we have to add these taxes in order to get the same answer. So see, if I add all these three income, you are not going to get the same GDP. So if you add these three and then add these taxes, you will get 1820, which is exactly the same. And when you subtract depreciation, indirect taxes, then you get the same answer, 1405 net. And when you adjust this net foreign factor income, you will exactly get the same answer. So you're getting the same answer in both approaches, of course, after making these adjustments. So now I'm going to give you definitions. So now I'm going to give you definitions, all these definitions, and I will provide you these definitions, right? So don't worry. First, if I ask you to calculate GDP at market price, remember, we are using expenditure approach. So GDP at market prices, just add these four terms: consumption, gross investment, government expenditures, and net exports, which is exports minus imports. If I ask you to calculate GDP at basic price, then you have to subtract indirect business taxes. Okay? When you subtract, not depreciation, the moment you subtract depreciation, this G would become N, net. When you subtract depreciation, you get NDP. Now this term is called foreign. Let me show you here. This called is net foreign factor income. What is net foreign factor income? This is how we calculate. Actually, what we are doing, notice here. Let me first erase this and then I will discuss in a moment. Now, notice what I'm doing here. Basically, I have this number, which is this. I have NDP, net domestic product. Net domestic product means that net means we are excluding depreciation. Domestic means goods and services produced within Canadian border. Doesn't matter who are producing. So for example, if foreign workers are working, if students are working in Canada, their contribution will be included in Canadians' GDP, although they are not citizens, they are not nationals. If I convert this NDP to NNP, this in the middle N, this is net national product, not domestic, national. What is the difference between domestic and national? Domestic means production being produced within the country, doesn't matter whether they are being produced by Canadians or non-Canadians. National means all goods and services produced by Canadians, doesn't matter where they are residing. So if a Canadian is working in Australia, his or her income will be included in Canada's G or NNP, national product, not domestic product, national product. So national means not necessarily within the Canadian boundaries. Okay, how we are going to make this adjustment? So if I want to find out the net national product from net domestic product, what I need to do, I will have to add incomes that is earned by all Canadians outside Canada, because inside Canada they are already been included in NDP. So we have to add. So all those Canadians who are working outside Canada, we add their income. And then those non-citizens who are living in Canada, their income is included in the GDP of Canada, but not in NNP or GNP. So we have to subtract their income. So then we subtract income earned by foreigners in Canada. If we make this adjustment, so notice here, see this. So net foreign factor income is, let's say, minus 33 whatever million dollars, minus 33. So I'm just writing this as I'm just making up. I don't know what is the total, but suppose minus 33. So if I write income earned, let's say income earned by Canadian outside, let's say this number is 100 million, suppose. Then income earned by foreigners in Canada must be 133. So basically, Canadians who are working abroad, they are earning less than what foreigners are earning in Canada. Okay, that is why we have minus 33, because 100 minus 133. So the answer is minus 33. So if you have a negative net foreign factor income, it means foreigners are earning more than Canadians who are working outside Canada. Okay. So you have to remember these formulas. Now, income approach, these are all formulas. National income, compensation of employees, gross operating surplus, gross mixed income. Then you have to adjust. Then net national income, just, I think I should have written here, rather than writing this, you could have done this as well. So you just write GNI rather than writing national income, gross national income, and then add those two taxes, if you remember, taxes on production and indirect taxes. And then if you get NNI, you have to subtract depreciation from GNI. So this is GNI. Then NDI, same thing. And then GDI is NDI, depreciation plus indirect taxes, right? So this is how you get, actually, this is exactly the same what is shown here if you get confused here. Oh, sorry, why I'm going out. This is exactly the same numbers, right? Not numbers, same formula. Okay. Then we have two more definitions. One is called personal income. What is personal income? Personal income, the formula is net national income. I have calculated here, if you see here. So this is net national product. If you use income approach, that is called net national income, which is here. So net national income is this. No, this is gross. This is net national income. Sorry. Let me erase this and show. I'm sorry if I'm confusing you. So this is net national income. Okay. So this is the net national income. That is the income of all Canadians. Doesn't matter where they are working. And net means we have already subtracted depreciation. If we want to find out what is personal income, then we add transfer payments. So personal income include income that you haven't earned but you receive. A scholarship, for example, or different government aids. You're not earning that. You're not working against that aid. You're just receiving. So we add this income and we subtract the income that you actually earned but haven't received. For example, undistributed profit. This is what we call retained earnings to fund future growth. So corporations don't give you 100% profit. They will keep a certain percentage of your profit as retained earnings in order to invest for future growth, and you have to pay corporate profit tax. So although you earn profit, but you are not getting that, receiving that money, you are paying taxes. So personal income is basically net national income plus income received but not earned minus income earned but not received. If you make this adjustment, you will get personal income. And then in personal income, if you pay personal income taxes from your income, that is called your disposable income. And disposable income is, there are two options for disposable income. Either you consume means buy goods and services, or you save. So I have written here that saving equal to disposable income minus consumption. So these are all national income accountings. I really don't know what to do, but you have to solve practice question that will help you understand and how to calculate this. Right? Now we have two types of, not types basically, there are two ways to calculate GDP. One is called nominal GDP, the other one is real GDP. When I tell you that you calculate GDP by adding all expenditures, and you are actually valuing all those goods and services at market price, because I said GDP at market price. So maybe suppose if Canadian economy is producing same goods and services that was produced last year, but because of the high inflation rate, if you multiply those goods and services with the current prices that are higher because of the inflation, you always have a higher number. So it means that your GDP has gone up from previous year, but in real term, you are still producing the same goods and services. You get a higher number simply because of higher prices. So if you don't incorporate this, if you don't, exclude the price effect, this is what we call nominal GDP. So the value of GDP in terms of prices prevailing at the time of measurement. So if prices are increasing, definitely your nominal GDP will increase because you are multiplying by a larger number. What is real GDP? The value of GDP measured in terms of prices. So you value all those goods and services by multiplying prices, but in different years. Or in a specific year, not years, in a specific year. This is what we call base year. So for example, if you think that 2012 is a base year and you calculate GDP for 2022, taking 2012 price level, and then see that actual production, whether actual production goes up or goes down, because we actually exclude the impact of price level, that is impact of higher prices if there's an inflation. Now why not just take an example and calculate nominal GDP and real GDP, and that will clarify the distinction between these two. So this is a simple example. So instead of taking, 5,000 goods and services, I've taken only four: machines, kilometers of road, bread, cars. And these are units, quantity of output. In 2016, prices for these goods are given also in 2016, same year. How to calculate GDP, nominal GDP? Just calculate the value. So if you want to buy 130 machines and the price is 125, you have to spend 16,250. So that is the expenditure. Similarly, that is the expenditure, that is the expenditure. You add all these expenditure, you get GDP. This is called nominal GDP. Now, if I value these goods and services in 2016, produced in 2016, with price in 2014 instead of the current market price 2016. So see, now I am considering price of 2014 instead of 2016, because notice that in 2016 prices are higher. It was in 2016 it's 125, in 2014 it was 100. 350 only three $2, 840 $800. So if you want to calculate the GDP of 2016 by eliminating the impact, the price impact or price effect, this is how we calculate. So we value these 130 machines by multiplying the price of $100 per machine. So I have total expenditure of 13,000. If we add all these, I get 50,100. Look at this. Nominal GDP is higher than real GDP of 2016. Why? It's because of the prices. Price has gone up also from 2014 to 2016. That's why your GDP has gone up. Okay. Now let me give you the actual numbers. And this is the actual data actually. Although I did not write, but it should be in trillions of dollars. The real GDP in Canada, it's written here, in 2018 time period, but it's in trillion dollars. In the real GDP in Canada in 2018 is $1.609 trillion at 2012 constant prices. So we have taken 2012 constant prices, and it's a chain method. So don't think that we are taking 12 years old price. We have actually taken since 2000. So we should see when we calculate GDP, 2013 we use 2012 price. Then for 2014, 2013 price like this. Okay. And nominal GDP in Canada in 2018, same year, using the same market price is, it's written here. So why I said it's not written, it's trillion dollars, is this. So look at this. Nominal GDP is this. Real GDP is this. So the impact of price is, we can easily calculate. What is the impact? The impact is 1.79, and if we divide by 1.69, if I multiply, that's fine. If I don't multiply, it doesn't make any difference. So I get 1.06. 1.06 simply means an increase in 6%. So price is 6%. So increase in price level is 6%. So from the base year to 2018, price has gone up by 6%. That is why your GDP increases by, nominal GDP increases by 6% from real GDP. So I just write this formula. You can play with these three variables. So if you have real GDP, if you want to calculate real GDP, if you have nominal GDP, and if you have this price index 1.06, this is what we call GDP deflator. When we talk about inflation, we normally calculate inflation using consumer price index. This is another index. This is called GDP deflator. This is also a price index, but this index includes the price of all goods and services. So for example, tanks, fighter jets, bomb, these are all included in GDP deflator. But in consumer price index, if prices of fighter jet F-16 is if the price of F-16 aircraft is increasing, it does not hurt me. I don't mind because I'm not going to buy anyways. So that inflation is not useful, and therefore we use consumer price index to calculate inflation. That is the increase in price of consumer goods and services that we normally buy. Okay, so if you divide nominal GDP by GDP deflator, you get real GDP. So remember this formula as well. Now, how to calculate growth in real GDP per capita? The formula is given here. So it's so easy. This is the formula. Current GDP, PC means per capita, minus previous GDP divided by previous GDP times 100. Or if you multiply by 100 and then divide, doesn't make any difference, right? So you can easily calculate growth of real GDP per capita. Now, problems in measuring GDP. So some of these goods and services will not be included in GDP. Remember, inventory investment will be included. So if you're unable to sell in that specific year, you will actually put in your inventory. That inventory investment will be included in GDP. These are the items that are excluded from GDP. Number one, intermediate goods. Intermediate goods are not included. So for example, if I buy, let's say, sugar, in order to use in baking cake and then I sell cake, then sugar would become an intermediate good. And there was sugar. That expenditure on sugar will not be included because the value of sugar has already been included in the price of cake. So if you include your expenditure on sugar and if you include the expenditure on cake, both, basically you are double counting. So you are basically counting sugar twice. So we don't include intermediate goods. If you are buying intermediate goods to use and produce another product, final product, that is why, if you remember, I showed you the definition of GDP that says the value of all final goods and services, not intermediate. By final goods means they are ready for consumption or not at least use for further production. But remember the difference between intermediate goods and capital goods. Okay, sales that merely transfer ownership. So this type of expenditure will not produce any good or service, and therefore there are no production. There is no production. So we are not going to add this. For example, let's say if I buy a stock from another investor, so that is not that is my expenditure. Buying stock will not be included in GDP because there's no production. It is simply a transfer of ownership. That investor owns that stock. Now I own that stock. Simple. Public and private transfer payments. So I already discussed this. Transfer payment means when government is giving money, right? In terms of subsidies, in terms of scholarships. So these money will not produce anything. Second-hand goods will not be included. Underground activities, both illegal and unreported but legal activities. So those, suppose if someone is working on cash, that is not included because that is not reported actually. Non-market activities will also not be included. Services for homemakers, do-it-yourself production. This is not self-employment, that is different. And volunteer services. So these are all categories that are not included in GDP. So we don't include them when we calculate GDP. Now, sources of economic growth. By economic growth, I mean increase in GDP. So these are the four sources. That is the four factors of production. Simple. If you have more factors of production, you are going to produce more goods and services. I am not saying that you just use the existing production factors of production. So, for example, if you are using your unemployed resources and produce this is not growth. Growth is when your capacity to produce increases. And that is only possible if you have more factors of production. So, for example, if you have more workers through immigration, that is the increase in labor force and workers. That will increase your productive capacity because of technology, because of these are all four factors. So, number one, quantity and quality of labor resources, if it increases, amount of physical capital available, if this rate of technological change, amount and quality of natural resources. So all these factors will contribute to economic growth. By production function, I mean that this is the GDP and this is a function of labor, capital, natural resources, and enterprise. But the most important factor in economic growth, capital, natural resources, and enterprise. But the most important factor in economic growth of these developed countries, including Canada, is a rate of technical change, that is technology. Now, what are the benefits of economic growth? By economic growth, I mean increase in GDP, okay? The capacity to produce more. Better health services, improve quality and length of education, better so you can check this data on Google, the life expectancy. So life expectancy is pretty high in these developed countries, around 80 years or 81 years. Improve quality and length of education, better transport, more support for arts and culture, and better protection of the environment, also protection of human rights. So these are the advantages of economic growth. But there are, higher GDP is not always better because it does not address some important issues. For example, the quality and desirability of the goods produced is ignored. So suppose if you are producing more and more, but if the quality is very low, that is not good for the consumers. Second, if the government or if the economy is producing more defense goods, related goods and services that we don't need, GDP will be very high. But this is not good sign for common man in the country. Per capita GDP will fall if population growth exceeds the growth of GDP. So although you are producing more goods and services, but at the same time, your population is also growing at a faster rate. So only higher GDP doesn't mean anything. You have to consider, that's why I showed you in the previous two slides that we have to calculate the growth in per capita income, per capita GDP, not absolute GDP. If you look at the absolute GDP of China and India, you'll find a very large number. But if you divide by 1.4 billion people, then per capita income will be very low. The social and environmental costs of higher GDP are ignored because when you are producing goods and services, you are basically imposing cost on your future generations by degrading the environment. So these costs are ignored, and sometimes we call it sustainable GDP. By sustainable GDP, I mean that you should produce goods and services in such a way so that you don't impose cost on future generations. So that's all as far as these topics are concerned. Thank you so much. Take care. Bye-bye.